$2.90. October 16, 1973. A hotel conference room in Kuwait City. 5 oil ministers took their seats at the table. Their statement ran a single line. The barrel price, $2.90, would rise to $5.11. 76%, in one announcement. They negotiated with no one. No American, no Briton, no Frenchman sat in that room. The men who had set this number for 45 years were absent, and for the first time, the oil states named their own price. In 36 hours, a right that the West had held for 60 years quietly changed hands. This is not a story about why the price went up. It is about the 3 reversals that rise created. Who took the right to set the price, where the dollars from that price went, and how the shock reshuffled the winners of an industry. The real event of 1973 was not a price hike. It was the moment 3 rivers reversed at once. For a century, one river had flowed in a single direction. 1928. Achnacarry Castle, Scotland. Exxon, BP, Shell, Mobil, Chevron, Gulf, Texaco. The heads of the world's 7 largest oil companies gathered in one room and made a pact. We set the price of crude. We set the production volumes. The world buys oil at the price we decide. The cartel held for 45 years. In 1971, the barrel price stood at $1.80. The cost to pull it from the earth, 5 cents a barrel. Resource rent, 1 cent. A perfect buyer's market. The first crack appeared on October 6, 1973. Egypt and Syria struck Israel without warning. Yom Kippur, the holiest day on the Jewish calendar. The war shook the Middle East. Western analysts stayed calm. A temporary shock. Oil will normalize. They were wrong. The price of that error appeared as 90-minute lines outside gas stations. October 17th, day 11 of the war. OAPEC, the Arab oil exporters, issued a second statement. No oil to the United States or the Netherlands. Production cut by 5% every month, until Israel withdraws from the occupied territories. The physical cut was 9% of global consumption, not 10, 9, and the market collapsed. One reason. Oil is an inelastic necessity. Without it today, just as yesterday, factories stop. 9% less supply created 100% fear. Lines formed at gas stations across America before dawn. Columns of cars stretched kilometers down highways, blocking traffic. Green flag, fuel available. Yellow, 10-gallon limit. Red, nothing left. Wait times passed 90 minutes. The government issued rationing. Odd license plates on odd days. Even plates on even days. Fights broke out over queue jumping. The world's largest oil producer, pumping crude in Texas and Alaska, found itself on a leash held by a small coalition in the Middle East. In Britain, the energy crisis detonated a structure already unstable. The oil shock was the spark. Coal miners and railway workers provided the fuse. January 1, 1974. The Heath government restricted commercial electricity to 3 days a week. A fragile structure met an external shock and broke. Factories ran on candles and kerosene lamps. Over 1.5 million workers went home overnight. Television broadcasts cut at 10:30 p.m. A government minister told the nation, "Brush your teeth in the dark." Prime Minister Heath called a snap election. Who governs this country? The government or the unions? The British public, exhausted by cold and darkness, had already decided. He lost. An energy crisis brought down a government. In Japan, toilet paper disappeared from shelves. The oil shock bred inflation fear, and inflation fear spread beyond oil products. Japan's Consumer Price Index in 1974, 23%. A post-war record. Not every country broke the same way. West Germany's Bundesbank tightened money supply hard and caught inflation early. The same oil shock, different institutions, different outcomes. The numbers record that year, January 1974. The barrel price reached $11.65, 6.5 times the 1971 price of $1.80. In 3 years, U.S. consumer price inflation, 11%. The Dow Jones fell 45%. The air went out of the room. The American drivers standing in those lines didn't know it. What they were losing wasn't gasoline. The river had begun to run backward. No one could stop it. The real transfer was just starting. The first river reversed direction. The right to set prices had moved. Back to October 16, 1973. The core of what happened in that Kuwait conference room was not the number on the price tag. It was this: the power to set the posted price, monopolized by the Seven Sisters since 1928, passed for the first time to OPEC. It was not a negotiation. It was a notification. The posted price is the tax base that oil-producing governments apply to oil companies. Not the spot price traded on markets, the number that determines how much tax the concession holders owe. OPEC's ability to change that number without the oil company's consent meant one thing: the question of who captures the resource rent had been transferred. The pricing power itself had moved. King Faisal of Saudi Arabia acted unilaterally on October 17th. He imposed an embargo on the United States. The White House called. Faisal didn't answer. 18 months later, Saudi Arabia was the world's largest foreign exchange holder. $20 billion by the end of 1974. Cash equivalent to 5% of the U.S. federal budget, accumulated in a single year. Across OPEC, the scale becomes clearer. OPEC's current account surplus, under $5 billion in 1973, surged to roughly $68 billion in 1974, a near 14-fold increase. For the first time, the direction of global capital flow reversed. Where did those reversed dollars go? The second river changed direction. The path that capital takes home had moved. America had a problem. In 1971, Nixon suspended dollar convertibility to gold. The anchor was gone. The world needed a reason to keep holding dollars. Petrodollars, oil payments, were piling up in the Middle East. If those dollars didn't come back, the currency would unravel. Saudi Arabia had a problem too. Money had arrived, but there was nothing to protect it. Iran's Shah Pahlavi was pushing to cut production to sustain high prices, and regarded Saudi Arabia as a potential threat. Two fears, same table. America guarantees Saudi security. Saudi Arabia sells oil in dollars and buys U.S. Treasury bonds with those dollars. June 1974, Henry Kissinger designed the architecture. Treasury Secretary William Simon flew to Riyadh. He brought weapons. He came back with dollars. Simon pressed Saudi Arabia's fear at the negotiating table with precision. Saudi Arabia has 150 years of reserves. Iran has 15. When Iranian oil runs out, Iran may come for Saudi Arabia. The security frame shifted the balance of the table. Simon and the Saudi government signed a secret agreement. Saudi Arabia would accept only dollars for oil exports. Those dollars would be used to purchase U.S. Treasury bonds. The United States would provide Saudi Arabia with military protection and weapons. Oil became the dollar's new anchor. The petrodollar system was born. Saudi Arabia had one condition: never make it public. If it became known that the guardian of Islamic power was financing the deficit of Israel's closest ally, the Arab world would ignite. The U.S. Treasury buried Saudi holdings under the line item, Oil Exporting Countries, for 41 years. Bloomberg's Freedom of Information lawsuit in 2016 finally pulled back the curtain. The reversed flow built a new reservoir. Petrodollars poured into London's offshore markets, and the eurodollar market expanded. Roughly $182 billion in 1975, $522 billion by 1981, 3 times in 6 years. A sea of dollars beyond the reach of any central bank, drifting outside all national borders. At the same time, a different transaction was underway inside Aramco. Before 1973, the rights to extract, refine, and export Saudi crude were held by 4 American oil companies: Chevron, 30%, Texaco, 30%, Exxon, 30%, Mobil, 10%, Saudi government ownership, 0. January 1973. The Saudi government acquired its first stake, 25%. 1974. With the oil shock placing Saudi hegemony at its peak, the stake climbed to 60%. 1976. The CEO of Exxon signed papers on the steps of a Saudi government building. From that day, Aramco was no longer an American company, 100% Saudi. The compensation? $1.5 billion, 100% stake in the world's largest oil reserves, handed over for $1.5 billion. Saudi Arabia accepted only book value, stripping out future worth. The 4 majors took the terms. Why didn't they resist? The word here is not nationalization. The fact is this: ownership and control are not the same thing. The technical workforce to actually run Aramco still belonged to the Western majors. Saudi Arabia had no choice. It kept the 4 majors on as contracted operators. The nameplate changed, but the pipelines that moved the money didn't change overnight. Saudi Arabia got the title. The majors kept the cash generation. They surrendered the shell of equity and kept the steady fee flow. The third river changed direction. Industrial hegemony had moved. Detroit's cars were powerful, large, heavy, dominant. But to a consumer who had just waited 90 minutes at a gas station, that power was no longer a selling point. It was a liability. In that moment, a smaller car looked different. Small, quiet, fuel efficient. The Toyota Corolla and Honda Civic, once seen as poor choices, suddenly looked rational. The Civic achieved 35 miles per gallon on the highway, the only car that met U.S. emissions standards without a catalytic converter. At Toyota's Tokyo headquarters, the December 1973 meeting had a different tone. This was not a U.S. market entry strategy. This was an occupation strategy. In 1973, the Big Three held 82% of the U.S. new car market. Japanese cars, 9%. By 1980, Japanese market share had climbed to 21%. The Big Three fell from 82 to 65. 1979, Chrysler filed for a government bailout. The world's most powerful auto industry didn't collapse because Japan was brilliant. Structure created the opening. High oil prices changed consumer choice. Consumer choice changed the shape of the market. The Big Three weren't foolish. The world they had designed simply stopped working. America tried to fight back. 1981, a deal capping Japanese car exports to the U.S. at 1.68 million units per year. The result was ironic. With export volume capped, Japanese manufacturers shifted away from small economy cars and sent the U.S. higher-margin midsize cars and luxury sedans. Honda's Acura, Toyota's Lexus, both born in that process. The surest way around an export quota is to build the cars inside the country, blocking them. Honda began production in Ohio in 1982. Nissan in Tennessee. Toyota set up a joint factory with GM in California in 1984. The protectionist measures aimed at stopping Japan completed Japan's transplantation into American manufacturing. When power moves, a new intermediary always appears. The Seven Sisters closed pipeline cracked, and independent traders stepped through the gap. Mark Rich was the symbol. The oil states had reclaimed their fields but had nowhere to sell. Independent refiners had nowhere to buy. Mark Rich saw the opening. He negotiated directly with senior officials in Iran and Arab oil states, buying crude, then sold it to oil-starved independent refiners at a high premium. 1974. He left Philip Brothers and incorporated Mark Rich and Company AG in Zug, Switzerland. from zero revenue to $15 billion in 5 years. The company later became Glencore, the world's largest commodity trading firm. Rich's business model recognized no borders, no ideology. After the 1979 Iranian Revolution, when the U.S. banned Iranian crude imports, he continued trading with Iran through his Swiss entity. He bought oil in the gaps between sanctions and embargoes and sold into blockaded markets at a premium. 1983. The U.S. indicted him on 51 counts. He fled to Switzerland. In times of chaos, true wealth goes not to the person who produces the resource, but to the person who controls the path it travels. The power of oil trading dispersed from the majors' vertically integrated model to independent traders. But there is one more piece of evidence that the winners were not geniuses. The most aggressive winner of the first oil shock became its most dramatic loser. Iran's Shah Pahlavi. In 1973, he was the most forceful voice within OPEC, pushing for price increases. The oil money poured in. Annual petroleum revenues, $1 billion in 1970, reached $23.6 billion by 1977. Pahlavi was the oil shock's most aggressive winner. But a winner is not the person who receives the money. It is the person with a structure that can absorb it. Money entered Iran, but the ports were blocked, the workforce was thin, and prices surged. Cargo ships loaded with industrial equipment sat offshore in Iranian waters for more than 6 months, nowhere to unload. The oil money didn't make the state stronger. It tore wider the cracks already forming. As dollars poured in, inflation climbed. Farmers moved to the cities. Shanty towns rose on the edges of Tehran. Revenue was captured by a narrow, privileged class. While economic indicators hit record highs, the social foundation of the state was rotting from within. 1979. The Islamic Revolution. The king who had earned the most was removed the most dramatically. After the revolution, Iranian oil workers went on strike, and the second oil shock began. Structure creates opportunity, but without the capacity to manage that structure, opportunity becomes catastrophe. The reversal reshaped the terrain itself. Once a river changes direction, the second reversal comes faster. Countries that learned from the first oil shock withstood the second. 1979. They diversified energy sources. They rebuilt industries less dependent on oil prices. Those that hadn't learned took the same blow twice as hard. October 1973. 3 rivers reversed at once. Resource ownership moved east. Capital ownership moved west, reborn as the petrodollar. Industrial hegemony crossed the Pacific. All 3 currents are still flowing. We think of prices as numbers, but a price is the sentence of power. Who writes it? Who pays it? And whose vault receives the money? In 1973, the subject of that sentence changed, and from that point forward, the world began moving by a different grammar. When the river turns again, what matters is not the force of the current, it is which bank you are standing on.